If you passed away tonight, here's something most people don't know. Your family wouldn't be able to pull a single dollar out of your bank account tomorrow. Not next week, not next month. A will wouldn't change that. A notarized estate plan wouldn't change that. Hiring an attorney to draft the whole thing wouldn't change that either. There's exactly one document, free 10 minutes to fill out, that solves this entirely, and almost nobody's ever heard of it because the industries built around estate planning have no reason to mention it. I'm William Tong, and for years I've represented clients directly in dealings with the IRS and sat across the table from bank compliance departments when things go wrong. If this kind of breakdown is useful to you, subscribe. Every week, I take apart a piece of financial or legal machinery like this one so you actually understand how it works, not just that it exists. Here's the disaster I see more than anything else, and it isn't a bad stock pick or a tax filing error. It's a family walking into a bank branch days after a funeral, only to be told the account is frozen because one specific form, one that costs nothing and takes 10 minutes, was never on file. Nobody warns families about this ahead of time. That's exactly why I'm making this video. The legal structure controlling your money, and it's not your will. Most people have never heard of the Uniform Probate Code, finalized back in 1969 by the National Conference of Commissioners on Uniform State Laws. What it did, in simple terms, was carve bank and credit union accounts out as their own category, treated legally as contracts entirely separate from anything in your will. Every state has since built its own laws around this same framework, and courts have upheld it consistently ever since. Translated into plain English, what happens to your cash when you die is decided by your contract with the bank, not your will, not a trust, not the estate plan you paid an attorney to draft. A signed beneficiary form on file at your bank beats a notarized, witnessed will every single time. Your will still governs your house, your car, your belongings. It has no authority whatsoever over your bank account. If no beneficiary is listed, your account doesn't pass to your family directly, it falls into your estate, and that automatically opens probate. Most states set that trigger somewhere between $50,000 and $100,000, which for most people who've actually saved for retirement is an easy threshold to cross. Once you're over it, your family isn't on their own timeline anymore. They're on the courts. And probate is never quick. Almost every state requires a waiting period, usually 3 to 6 months, specifically so any creditor, hospital bill, or credit card company can come forward with a claim before anyone gets paid. It doesn't matter how organized your finances were, your family still waits out that clock. Meanwhile, the funeral home isn't waiting, and grief doesn't come with a payment extension. Walter's story. Everything was handled. It wasn't. Walter was 74. A retired mechanical engineer who'd sold his small business a couple of years earlier and deposited $420,000 into a single account at his local bank. He did what most people are told is the responsible move, paid an estate attorney $950 for a full will, properly witnessed and notarized, splitting everything evenly between his 2 kids, James and Claire. He told them both it was taken care of. Then he had a fatal heart attack. James and Claire flew home, were handed a $9,800 funeral bill, and brought the death certificate and the notarized will straight to Walter's bank. The employee behind the counter looked at both documents and explained calmly that none of it mattered. There had never been a payable-on-death designation filed on the account. It was in Walter's name only. Because the balance was well above the state's probate threshold, the bank had no legal way to release any of it, will or no will. The kids covered the funeral on their own credit cards at just over 22% interest, while $420,000 of their father's money sat completely out of reach. Then the probate costs started piling on. A $410 court filing fee, a $275 newspaper publication notice required to alert any unknown creditors, a $1,200 executor bond, and a probate attorney's cut billed as a percentage of the estate, which is standard practice in a lot of states, that came out to more than $12,600. The mandatory waiting period kept the case open for 11 months. By the time it was over, the family had lost more than $14,000 to fees and interest on money that was legally theirs the entire time. Walter didn't do anything wrong. He had the will, the attorney, the notary stamp. Everything people assume covers this. None of it ever touched the actual contract at his bank. This isn't a rare mistake. It's the system functioning exactly as designed. Before I walk through the 3 specific ways this happens, pull up your bank account right now, the app, or a recent statement, and look for a beneficiary field. If there isn't one, or it's blank, you already have your answer. 3 ways people lock themselves out of their own money. The first, and most common, is simply never naming a beneficiary. The account was opened years or decades ago, nobody at the branch ever brought it up, and it was just assumed the will would cover it. It doesn't. Estate attorneys draft wills, they almost never file a bank's beneficiary paperwork, because that's a completely separate document handled by a completely separate institution. Nobody mentions that gap when you're paying for the estate plan. The second is worse because it feels like it's already handled, an outdated beneficiary designation. Maybe it's an ex-spouse from a marriage that ended 15 years ago, or a sibling you've lost touch with, or a parent who's already gone. Whatever name is still sitting on that form is legally who gets the money, regardless of what your current will says. Court side with the designation on file, not the newer document in your desk drawer. The third is assuming joint ownership handles everything automatically. Plenty of married couples assume that because they're married, accounts pass to the survivor without any extra step. In a lot of states, that's not automatic. Joint tenancy with right of survivorship has to be specifically set up at the branch, and there's a hidden cost inside the most common attempted fix, adding an adult child as a joint owner so they can help manage the account. The intention is good. The exposure is real. The moment that child is added, the law in most states treats the money as partly theirs, right now, while you're alive. If they're sued after an accident, that account can be pursued. If they divorce, it can end up part of a settlement. If they owe the IRS, it can be levied. A payable-on-death designation sidesteps every bit of that. Your beneficiary has no ownership and no exposure while you're living, and the account transfers cleanly, without a court, the moment you pass. I've also put together a full state-by-state list of senior tax exemptions and credits most people qualify for and never claim. It's linked in the pinned comment under this video if you want to check what applies where you live. The form that makes probate irrelevant. That fix is called a Payable-on-Death designation, or POD. It traces back to a 1904 New York court case known as the Totten Trust decision, which established that money could pass directly to another person at death without going through a formal trust or court process. That principle is now written into the Uniform Probate Code and adopted in some form in all 50 states. A POD isn't a will, and it isn't a trust. It's a direct instruction sitting on file with your bank, on the exact same contractual track that froze Walter's account. That's exactly why it works. The bank never has to look at probate court. It just looks at what's on file. When a valid POD is in place, your beneficiary shows up with a certified death certificate, the bank verifies it, and the funds move. No judge, no attorney, no mandatory waiting period. Smaller banks often process it same day or the next business day. Larger ones typically take 3 to 5 business days. What it never takes is 11 months. Every FDIC-insured bank has to offer it. There's no fee to file it and no fee to maintain it, because it doesn't make the bank a cent. It's built purely for you and whoever you name. Where a POD stops and what to file instead. This is where most people quit too early and leave real gaps. A POD only covers your individual bank accounts, checking, savings, money market. It doesn't automatically extend to every product at that same bank. CDs each need their own separate POD filed. 3 CDs means 3 separate forms. Brokerage accounts run on a different form entirely, called Transfer on Death, or TOD, filed with your brokerage instead of your bank. Without it, your stocks and funds go through probate just like an account with no beneficiary at all. Retirement accounts, IRAs, 401ks, 403bs, already work this way under federal law, but most people set that designation once, decades ago, and never revisited it. That old designation legally overrides your will and even a divorce decree, so if an ex-spouse from the 1990s is still listed on an old IRA, they can legally claim the entire balance, no matter what your current documents say. One more asset trips people up constantly: the safe deposit box. Keeping your will and valuables inside one, with a spare key held by a family member, does nothing once you're gone. Banks are required to seal the box the moment they're notified of a death, key or not. And if the actual will is sitting inside, your family hits a circular problem. They need the will to open probate, but need a probate order to open the box. The fix costs nothing. Add your child as a joint renter directly on the box contract at the branch, and their access survives you automatically. Before you close this video this week, go to your bank, in person or through your online portal, and request the Payable-on-Death beneficiary form. Every FDIC-insured bank has to provide it. If the teller doesn't know what it is, ask for the branch manager. 2. Name a primary beneficiary using their full legal name, date of birth, and social security number, not a nickname, not my kids. The bank uses that number to verify identity when it's time to transfer funds. 3. Name a contingent beneficiary as a backup. If your primary beneficiary dies before you, and there's no contingent listed, the account falls back into your estate and probate opens anyway. 4. Submit the form in person and get written confirmation it's on file. Keep it with your other important documents. 5. Check every account separately. Checking, savings, and each individual CD all need their own form. 6. Contact your brokerage directly and file a transfer on death designation on any non-retirement investment account. 7. Review the beneficiaries on your retirement accounts and update anything outdated through your plan administrator. 8. Revisit every designation every few years or after any major life event: a death, a marriage, a divorce, a new grandchild. Right now, tonight, your family still can't touch $1 of your money unless this form is on file. Probate isn't broken. It's working precisely the way it was designed to. The POD designation is simply the one mechanism that rides that same legal track and wins. Go to your bank this week and ask for it. It costs nothing. It takes 10 minutes. And if this helped, subscribe.